have next, a real treat for all of you, a panel that's going to be focused on what's ahead with the ag economy. And we're going to kind of do it in two parts. We're going to have our keynote on the panel, Dr. Seth Meyer, USDA's chief economist, and then we'll have separate presentations by the rest of our panelists, and then we'll take your questions again as we have in the past. So I mentioned Dr. Meyer a little bit earlier. He's always been so gracious to come in and share with us. And as you might remember, this is kind of the fall outlook, but we're also happy to be a precursor to what he does with the World Outlook Board in Washington, D.C. in February, and next year will be the 100th anniversary of the annual Ag Outlook Conference. So we welcome participation in that as well. Seth was appointed as USDA's chief economist in January of 2020, returning to USDA after 2 years. Prior to that, he was a research professor and associate director for the Food and Agricultural Policy Research Institute. And I think we've got some FAPRI friends here as well. Prior to his stint at FAPRI, Dr. Meyer was the head of the World Agricultural Outlook Board, previously an economist with the Food and Agricultural Organization, or FAO, of the United Nations, a visiting scholar at several research institutes. He grew up in my neck of the woods, eastern Iowa, has a bachelor and master's degree from Iowa State University, a Ph.D. in Ag Econ from the University of Missouri. So please welcome Dr. Seth Meyer.
Thank you. All right, it's great to be with you here today. So while I am chief economist at USDA and we have pretty broad responsibilities, for instance, Rod Snyder from EPA was talking about a lot of his interactions with USDA. A fair amount of those actually go through my office. But I'm going to do I get to talk about something today which is much more comfortable to me, which is a basic outlook of agricultural markets. So happy to answer questions when we get to the discussion part about policy, et cetera. But I'm just going to give you a flavor for agricultural markets. So the classic graph that I almost feel compelled to show at every presentation is to talk about where we've been in terms of prices. Obviously, you can come through here and see that since 2020, we've seen prices begin to rise since the fall of 2020, in part that being China returning to the global trade market and to the US market. Prices jumped during the beginning of the war in Ukraine. They've since come down, and now we've started to see, for the most part, prices easing as we go forward. But, and this is a complicated graph, and I thought about whether I should show you this one or not, but it does have at least one important element to it, which is this is a way to look at implied volatility. And that's really a way to say, where is price uncertainty within the market? And this is for corn and beans and wheat. And the dashed line, the white line there is kind of normal uncertainty in prices, and the orange line is where we're at now. What you can see is we're kind of heading in a direction where the market's much more sanguine about supplies for corn, for beans, and yet we maintain a fair amount of uncertainty for wheat. And I think that's not surprising given what we're observing in the Black Sea. And I'll talk a little bit more about that. But in a general outlook for agricultural prices in the coming year, and this is from the WASDE report, so when you heard that I used to run the World Agricultural Outlook Board, those are the folks that put together the WASDE report and are in lockup with NASS. So when you look at this, as we go forward for this crop year that we're at, it's basically lower prices for every crop. All the major crops we follow, lower prices. Obviously, we're coming down off of those very high prices from disruptions, including from the war, lower prices. Livestock being the exception on cattle and for swine. We'll talk maybe briefly about cattle. But the other side of this is, with falling prices, is falling input prices or slowing growth in input prices. We certainly saw in 2022 record farm income, but it wasn't without a tremendous amount of anxiety, right? Input prices were uncertain, rising, high. Ended up being a good year for many commodities that an Iowan like myself could love: corn, beans, cattle. Maybe less so for some other commodities. But what we saw is high prices for those commodities, good farm income, but with a lot of anxiety. Now we see both prices coming down, but, and inputs coming down, or at least slowing in the growth of those input prices, but with some narrowing, obviously narrowing of margins, coming up from very high farm income down to more normal levels of farm income. I talked about it. Here's the chart. So you see 2022, high farm income, lot of anxiety to get there, very strong farm income in aggregate. That's not every commodity. And now coming down to something that's a little bit better than the long run average, but certainly a big decline from the previous year, but still a pretty good year. So that's part of the context we find ourselves in. But let's talk a little bit about global agricultural markets, agricultural trade, and I'm the warm-up act for your next guests, so who will talk about this in detail. So I think the first thing that's important to throw up here, I think, is the situation with agricultural trade, and I think there's definitely several things to pull off of this graph. I know that Spiro from ERS talked to you both about the farm income, which his group does, which I just talked about, and they also participate in this along with our Foreign Ag Service. But what you see here is, again, return to trade after a few years of trade friction with China and higher output, higher commodity prices, resulting in increases in the value of agricultural trade. Another thing that you look at this is you notice a spread between imports and exports and actually seeing a net trade deficit. I think there's a couple ways to view this. One is dollar strength probably inhibits our exports and induces imports. Another way to look at this is I don't necessarily think about those two being close together as being a problem. Again, I told you I was from Iowa. In the wintertime, your ability to get certain products in the winter was pretty thin. Now when you go to Iowa, you can get whatever you want in the middle of winter. So trade does have its advantages for consumers in terms of counter-cyclical production and trade, but you like to see both of those things be strong. I guess I'm not as concerned if they're close together, but clearly some of that spread being induced by dollar strength. And here you can see at least who's contributing to that decline. Obviously, as China pulls back, perhaps less growth in soybean demand from the US, more opportunities to buy corn from other sources. Here's where you see a little bit of that reduction in ag markets coming from. Then another thing I kind of want to throw out there in broad, big picture, because it influences policy and several other things, is we've just come off of 3 years of a La Nina, and we're entering into an El Nino. Okay, so why does this matter? Well, some interesting things to point out is you tend to have inverse effects going from a La Nina to an El Nino. But here in an El Nino, you get dry in South Africa. You get dry through many of the places where rice is produced. You get better growing conditions in Argentina. You get worse growing conditions in Australia, right? So these things are largely switches in where things are grown geographically, but I think we're seeing some of the production effects on a global scale that we're seeing play out now have an El Nino contribution to them, not the main driving factor, but El Nino contribution to them, and it's beyond just the simple production effects. So I'll talk to you a bit about that real briefly. So let's talk, I'm going to talk about wheat, I'm going to talk about corn, I'm going to talk about beans, and I'm going to mention rice. I got to mention rice for a policy reason. So when you look at this, again, you think about some of the things going on, and you say, okay, Australian production should fall because we're switching to an El Nino. Perhaps not a surprise after 3 years, and we'll show you this, 3 years of strong production. And then at the same time, you look at this and you say, Russian wheat production falling. That's quite a big decline year over year. But another important aspect in global markets is that the Russians had an enormous crop last year. And they just have a really, really, really big crop this year. And so when you see a 7 million metric ton decline, that's off of a crop that others will say is even larger than that. That's an important aspect in global markets for prices, for food security, and part of the reason why you see increased volatility in wheat that you don't see in corn and beans. So again, I'm showing you kind of the classic WASDE briefing here, and when you think about Australia as an example and think about the impacts of El Nino after 3 years of very strong production, you got all the primary areas here where wheat is grown within Australia. So east, west, and south central. And you had dry conditions, not inconsistent with an El Nino. And you had dry conditions in June, You had dry conditions in July, and so you set yourself up for more dry conditions, and so you're moving around where good crops are more likely and where bad crops are more likely geographically. Not inconsequential for customers of Australia when it comes to wheat. And here you can see very clearly this is not all El Nino and La Nina, but it is certainly a contributor here where you have 3 good years in Australia and the 4th year is a return to maybe a subnormal prospect. Okay? Now, for corn, for beans, for wheat, the production changes are lots of shifts geographically and usually not in total. But we've got a couple things going on in wheat here where, again, we maintain a fair amount of uncertainty relative to some of the other crops. Ukraine. Here I'm showing you where conflict is occurring and where wheat is produced in Ukraine. Okay, so most of the wheat produced in Ukraine is outside of the conflict areas, but think about all the challenges facing a farmer in Ukraine. I equate this to being, and all the export ports closed, this would be the equivalent of closing the Mississippi River and Illinois sending Iowa its grain, right? You're sending grain into a surplus area already. The Iowans wouldn't be too happy about that. So you're seeing this play out in real time, and who pays for that transportation difference? It's the Ukrainian farmer, and that's why we've seen production cuts in Ukraine. But that, I don't think, is the total reason why we see volatility within the wheat market. Here, these are all the commodities that the Ukrainians are expected to export. You're talking about 3 million metric tons a month. This is stuff that can be done outside of those Black Sea ports. So the agreement on the Black Sea Grain Initiative in itself narrowly doesn't have a huge impact. In itself, narrowly. But what it does add, I think, is that food is different. The Black Sea Grain Initiative sets the tone that food is different because the world needs both Ukrainian and Russian grain. And unless you take the prospect that food is different and secure food out of the Black Sea, you would really cut about 25 to 30% of global wheat trade if you started hitting Russian ships or if other means of Ukrainian transportation were curtailed. So the Black Sea Grain Initiative in and of itself and the closing of those 3 ports, you might say, you're still exporting 3 million metric tons. But it is a signal that food is different. And I think that that's the key aspect of the Black Sea Grain Initiative, that it's important. All shipping of food should be safe. Food's different. All right? We have a drought. The Canadians have a drought. Here's another reason why we're seeing perhaps a decline in global wheat production. The Canadians seeing a fair amount of drought, both around their canola area, around their wheat area. And we're facing a similar drought in the United States. And I think that for those of you that follow this closely, it's basically moved its way east as well too. Over the last several years that drought's been there, it's just been kind of drifting east as well too when we look at the drought. And I think that this year in particular, the weather has posed pretty significant problems on I think, challenges for NASS in assessing the size of this year's crop. I'll say it, I don't know if NASS would say it, but I'll say it. I think it's a challenge when you have highly variable weather. But this is my only livestock slide. But it isn't just crops that are being affected by the drought. Okay? We're in a contraction phase of the cattle cycle. I know we have men on cattle producers in the room. I continue to look for a turn in this cycle given where cow, calf, and feeder cattle prices are at. Right? But folks will say, I don't know if forage conditions will support those cattle, and I want to take the money now. At least that's what the industry appears to have said so far. And so we haven't seen a turn. So when we think about the number of cattle to be slaughtered, that number looks like it's drifting out into a bottoming out in 2026 or beyond. So these are long-term effects of the drought are having on things like the cattle cycle as well. Another challenge that we had this year when I talk about the ability to estimate yields is we had dry conditions, and then we had timely rains, and then maybe we did, some other folks didn't, and then we had 112-degree temperatures at critical times of development within the US crop as well too. And that means predicting the size of a crop that's still developing becomes a real challenge for NASS, right? It's not as if you're trying to estimate the crop when it's done, you're estimating the crop into its production. So when I look at NASS's corn yield that just was out here on the 12th, you can see a decent yield in terms of corn, perhaps a little bit less than trend, but still a decent corn yield, but I think with a lot of variability around the country. We're to the stage in this crop production where we've gone from counting stalks to counting stalks and ears to pulling those ears and sending them to the lab for weighing. So many of these ears are either going to the lab or will go to the lab in October, and that's when we'll narrow this down for what I think has been a tricky year to estimate yields. But I think overall you're saying, well, okay, we got below trend yields, good sized crop in the United States, but we've got a tremendous amount of carryout at the global level. Or not a tremendous, we've got a big amount of carryout, an expanding carryout at a global level. And I think it's important to note who's doing that carryout. So down there at the end, you can see we're going from a little under 300 million metric tons to 314 million metric tons. And part of the reason we're facing challenges, and so I'll show you the US balance sheet, we're expecting to increase our carryout 50% year over year. So we'll go from about 1.4 billion to 2.1 billion bushels of carryout within the coming year on larger production, but also in the fact that we continue to see Brazilian production expand, both in corn and beans, access to that market now, access to those corn to Chinese markets now that they didn't have historically. And so I think at a global level, when it comes to corn and beans, we're facing increased competition. And that's also why I think you're seeing the volatility narrow, right? There appear to be substantive enough crops that folks aren't anxious about the pricing of those crops. Now, this one's hard to read, and I know Arlan, I know that some of our follow-up guests will talk about this, but I think there are opportunities. It's whether we get to see those opportunities in the United States. Basically, all the combined lines on the bottom are folks outside of China. That higher faint line is price inside of China. And let me tell you, it doesn't cost that much to get the corn from the Gulf to China. The cost is on getting it into China. So there's money to be made in importing corn into China, and that wedge is actually growing. We can have a long, detailed talk about TRQs, tariff rate quotas, and who controls the ability to get the corn into China. But let me tell you, that's more than $50 a metric ton to be made. And if you're importing 20 million metric tons, 10 million metric tons, somebody's making some very large amounts of money getting corn into China. And that wedge is growing, so it certainly does provide an opportunity, but we are now no longer, the Ukrainians have limited supplies. We're now no longer the only game in town, though, because now Brazil can get its corn into China. So when you think about overall exports of corn and soybeans in terms of our share, Argentina, Brazil, and Ukraine for corn, and Argentina and Brazil and us for beans, you can see in here too the decline in South American crops in terms of exports, and the US and the jump in Brazilian corn exports after a very good year. You can say, hey, we're facing competition going forward. Brazilians had a large second crop this year. Under normal weather conditions, they will see a strong rebound in their production. And normal weather conditions includes a shift from La Nina to El Nino in Argentina, La Nina being a negative for the Argentines and being a positive for an El Nino. So it's reasonable, a normal weather assumption would be a strong rebound, so we'll face additional soybean competition pressure going forward. And so it ends up being us that carry some of the global stocks. So you can see the rebound in US stocks again, a 50% increase year over year in terms of US stocks. Again, facing additional competition. And this is the latest balance sheet out of the WASDE report, just showing you that 1.4 to 2. I guess I said 2.1, but it's 2.2 billion bushels of carryout. So more than a 50% increase in carryout stocks going forward. Okay, so big production numbers, carry-out stocks growing, markets a little bit more comfortable with those levels of supplies, price volatility declines. Soybeans the same way. I think that soybeans from a maturity standpoint tend to be later than it does for corn, so less of it's gone to the lab. So NASS will have, again, more information in October. Both corn and bean yield estimates tend to narrow after October. Again, you're estimating the size of a crop the crop is developing into volatile weather, into heat, into rain and drought. So I think this year presents an additional challenge, right? It's a moving target that you are following throughout the year. But on the demand side for the U.S., you go, well, are we facing a challenge out of South America on those big supplies? Is that something to be really concerned about? Well, you always like strong export markets, but another aspect of this domestically is we've got pretty strong domestic markets for soybeans as well, too. And that's what's supporting probably a bean to corn price ratio above 2.6 this year. You got very strong domestic demand. And to the point that as we see estimates in yields change or production change within the United States, crush stays fairly stable and the difference comes out of trade and comes out of exports. Why? Because crush margin in the U.S. is pretty strong relative to history. We've got capacity growing a little bit. It's supported by positive crush margins. And so that crop is going to be crushed domestically, and that's also what's supporting soybean prices domestically. And a lot of that is based upon the oil value. You normally think about what's the contribution of oil making to the bean. It is much higher than it has been historically. On the order of 40% of the value of the soybean now comes from the oil share. Why? A lot of that being supported by domestic policy when it comes to biofuels, when it comes to the potential for sustainable aviation fuels. A lot of that, again, coming from demand for oil domestically supporting that soybean crush. Okay, so again, I think when we think about the balance sheet for soybeans, crush less responsive to price than exports or stocks. And here's really the competition we face in the export market. I'll show you. So you got 2 years of decline. Again, reminding you we're coming out of 3 years of a La Nina, negative effects in Argentine production, maybe some in Australia, to a more normal weather estimate, gets you over 211 million metric tons of soybean production. That's a big number, and that's what will be providing potential competition to us. Yeah, that crop could come up short, but it could also outperform. So there is at least one of the aspects when it comes to global supply, and I know some of the folks I'm doing the warm-up for will talk about the demand side. So I'm only showing you this to show you that despite the fact that we have exports which are maybe a little lackluster year over year, because crush demand is quite strong, and perhaps because of limited acres relative to what we might have expected, and below trend yields, tightening that market up a little bit, which is how we get a 2.6 soybean to corn price ratio. And you all are being awful quiet. I'm looking at facial expression. Are we doing okay? Okay, all right. Well, you're making me nervous. So, and I know we don't have many, we probably don't, do we have any rice producers? Anybody from the boot heel even? Okay, all right. Well, I'm going to talk to you about rice quick, not because I'm so concerned about rice markets, because I know we don't have many rice producers in here, but I want to talk about it from a policy aspect. What we have seen, you can look at this graph, and you can go back there, and you can see back when we had a real problem in rice markets about 2007, 2008. And then you can come in here, and you can kind of look in between there, reminding you all that the war in Ukraine started in February, actually February 23rd, because it was the night before a major speech that I had to give, which had an outlook for the next year in it, which was wrong after that, right? So I remember the date well. But what you have here is rice didn't come along for the party, so to speak, in terms of big increases in prices, but all of a sudden now it starts to turn north. Prices of rice have started to increase rapidly. Remember I showed you that in an El Nino Southeast, and East Asia tend to be very dry. It's where a lot of rice production occurs, part of the story. The other important part of the story is changes in Indian policy in terms of exports. So the Indians have gone from very modest exporters to taking off a significant share of what is a thin market in global trade for rice. So they've supported their domestic production, they've expanded, then they export the surplus, except when they get nervous. And this year, they're getting nervous and restricting exports. So they've cut their exports. 5.5 million metric tons is about 10% of global trade, a little bit more, that they've cut, and about half of their exports. That's what's driving prices higher. So in terms of being and they did this last year in wheat. So I think we have not gotten out of the woods yet for these type of reactions. I will say I think that these are not the kind of things which are supportive of global food security. When you're an exporter, you have a responsibility to be reliable. And so what you have here is an export control that sends prices in rice prices in the global market much, much higher. And at the same time, who are the people that are dependent on that rice? It's from the most food insecure in Africa who are the most price sensitive. So you're really transmitting your food insecurity into the rest of the world. So I think we had, during that really strong run in prices related to the war in Ukraine, you get people recommending these kinds of responses. I think these are not good responses in terms of being a reliable and developing export markets, nor are they a good prospect when you think about things about global food security. I think this is my last slide, and this is a slide which really just looks at days of use. It's like a stocks to use graph. It's kind of like stocks to use, but it kind of balances it against consumption in this. Say, how many days worth of consumption are we carrying in carry-out stocks? And Chinese stocks are excluded for all the reasons you can imagine, which is they're uncertain, they're big, they're not accessible to the market, are they real? All of these things which hang out there. But you can see that part of why the market was both tense when it comes to corn, when it comes to even beans, when it comes to wheat, and why it is getting more nervous when it comes to rice, and maybe moderating its concerns when it comes to corn and soybeans. So in this case, I think that the market, again, in conclusion here, I think the market's become pretty satisfied with where it's at for corn and beans. I think real risks remain in the global wheat market, and I think real risks remain in the global rice market, which could then kick off problems in other commodities if you have spillover in wheat from countries cutting off supplies of rice. And again, El Nino tends to affect rice, so there is some impetus to see some instability returning to the market, even if it's not in corn and beans. And with that, I am concluding, and I invite you all to the 100th Annual Ag Outlook Forum. You're so quiet. All right. Do you need me to sit down here? Or
If you'd like, you should be able to see still the...
Okay.
Not the very end one. Save that one for me. Oh, okay, one more.
All right.
Thank you.
All right.
Oh, well, they're just soaking it all in, all your great information. So, and there's more to come yet as we have this discussion. So I think that's maybe a little of the quiet here, but we're going to bring our next panelist up to this stage. Many of you are familiar with Arlan Suderman. He is the Chief Commodities Economist for StoneX Group, a financial service provider for global markets. Arlan oversees the company's commodity market intelligence efforts. Many of you might be following on Twitter like I do. Previously, he served as a senior market analyst at Water Street Solutions, an ag consulting firm, graduate of Kansas State University, and I'm proud to say that I once hired him back in the day. Thank you, Arlan, for joining us for opening comments.
Thank you, Sarah. I know Dr. Meyer and myself and the rest of the panel feeling like, how do you give an assessment of the ag economy in the time we have? It's kind of like the old professor said, give me a description of the universe in 25 words or less and give 2 examples. But we're going to try to do that. I'm going to focus on China, which is that big demand aspect that certainly contributed to the big commodity boom we saw 15 years ago. And that had its roots 20 to 25 years before that, when the middle class in China started coming forth. And I've addressed that in this group some in the past. And so what's the update with China? What's happening with China? Tensions with China are very tight right now, maybe as high as they've ever been during the reign of the Communist Party of China. And a lot of it revolves around Taiwan, but there's a lot of issues around that as well. If we look at that escalation, we're seeing that the United States and Europe are starting to deleverage themselves from China and from dependency on trade with China, starting to diversify. And specifically what we're seeing as a result, that's creating problems for China's economy. And as China encounters more and more problems with their economy because of our diversifying of our sources of goods and services, that's contributing to the tensions there as well. Chinese exports dropped 8.8% year on year in August after falling 14.5% year on year in July and a 12.4% decline in June. Shipments to the U.S. are down for the 13th consecutive month. China has an export-based economy, and they're trying now to start to shift that to a consumer-based economy, which is what the United States has, but that's not an easy transition to make. It takes time, and it's difficult, and there's some hurdles to go along the way. Now, China, one of the things that China's doing is they're now celebrating the 10th year of their Belt and Road Initiative, which is how they diversify their economy overseas. And I'll go into a little bit later why they're diversifying their economy overseas, but this gives them other countries to trade with and who can utilize the yuan, China's currency, as their primary source of trade. And so they're working on developing that right now together with their work with the BRICS nations, which is originally Brazil, Russia, India, China, then South Africa joined, and now a number of other countries are starting to join that as well. Trade with the Belt and Road Initiative countries is up 3%. Trade with Russia up 32.3% year on year. But even with those increases, overall trade is down, like I showed you in those initial bullet points there. Now, one of the key things that is driving policy in China is on this slide. China's population is no longer the largest in the world. That now belongs to India. That's because a couple of factors. First of all, you're well aware of the one-child policy that China had for many years, which they abandoned a few years back. And so that led to a decrease in new births, obviously, and India is just going right on past them, and now Chinese population is actually in decline. So if you look at it, there's 3 graphics there. And the top right graphic is the demographic of men on the left, women on the right, how many in each class by age group back in 1950. And like many developing economies, there was a lot of young people, very few old people. But as they have improved their wealth and their health, that people have aged and lived longer. And so if you look at the lower left graphic there, that's from 2010. And so you see this big bubble of people moving up, getting older. The red line across each of those graphs is basically the retirement age, which in China is 55 years of age for men, 50 years for women. So 55 years of age, and you can see that top right graphic, there's very few people above retirement age. But as you get in the lower left graphic, you see there's more people above it, but still a small part of the population. But then you see this shortage of people at the bottom of that demographic, and that's because of the one-child policy. Now, I said they've abandoned that one-child policy, but it's been hard to change the culture because, and some of my Chinese employees have helped me understand this, when you only have one child, you put everything into that one child succeeding, giving them the best education, the best tutors, so that you can excel above the neighbor kid and be the best that that one child can be, because all of their hopes and dreams are in that one child. And so raising a child became so expensive that culturally, when the policy changed, you just don't say, oh, okay, quit spending less on your kid. They kept investing, and so China's now trying to regulate tutors and education and everything to try to decrease the cost of raising a child so that people will have more children. But so far, it has not really been that effective. So you look at the graph like on the lower right, that's the projection for 2050. And notice that more than half the people there are above retirement age. So you have very few people supporting the elderly and continuing to support your economy. So if we look at the details in the script, and if you're in the back, you probably can't read that, so I'll kind of summarize it. 1 in 10 Chinese women are permanently childless. That's up 6% over the last 5 years alone. Women reported that they plan to have 1.64 kids on average in 2021, down from 1.73 kids in 2019. The average household size in 2020 was 2.6 persons, down almost a half unit, a half person, if you will, from 2010. Annual births are down 40% this year from 5 years ago. So low birth rates combined with an aging population to invert the population demographics, with the overall population total also now in decline. This represents some real challenges for the Chinese economy. Not only is it not producing to support the elderly, but that makes it more difficult for them to be the #1 economy and #1 military in the world, which is their stated goal. So therefore, they have to diversify their economy and spread their borders as it would, and that is part of what's driving policy in China. And you have to understand that to totally understand. Therefore, when we deleverage from them, they take that as a threat against them, that we're trying to threaten their survival as a country. That's what they believe. You and I would be baffled by that. I've got some Chinese employees I gathered together one day, and I said, why do you think Taiwan is so important to the United States that we would want to defend their democracy? And one of them said, oh, that's easy. He said, you want a base from which you can attack China and dominate and control China. I said, what? He goes, yeah. I said, no. If you would survey the American population, you wouldn't find 5% of the American population that wants to do that. Well, it doesn't matter what the people think. It's just what the central government wants to do. This is America, I said. We vote for our elected officials. Yeah, but that's what they want to do. But that's the thinking. And so you have to understand the thinking. And that's why I explained to them how we hear things depending on the culture that we've grown up in. And that is the culture they've grown up in. That is the culture of the Chinese when they set policy. So if we look at pork production in China, I mentioned the growing wealth in China was responsible for the last commodity boom we had, and the biofuels revolution was simply a contributor to that. And that was because China was moving millions of people to the city every month. Their income's going up. The first thing they want to do is go from a starch-based diet to a protein-based diet. And so they're eating more meat. That takes more grain and oil seeds to produce. But now that's flattened out. We had African swine fever in 2018, cut the number of hogs that were available by 50 to 60% at one point at the worst. And people found other protein sources, some meat and some other alternatives. And so with declining population now and declining inclusion of soy meal in the rations, China has a goal of going from 17% inclusion a few years ago, 2019 I believe it was, to 12.5% by 2025. So unless China finds a new use for soybean meal, we basically have seen peak soybean meal demand in China. So we need to be looking for other sources of demand, which is what the soybean industry is doing. If we look at total grain imports, the final column there, of course, is year to date. But I wanted to show when we started this marketing year, very low on export sales, largely because of China, buying less commodities, buying more and more of it from Brazil. So our exports are sluggish. We're dependent more on crush. We're building that. You see the blue bars there on the right-hand side are the new imports from Brazil on corn. We're looking at 80 to 100 million bushels coming from Brazil to China just in September and October alone for corn. If you look at Ukraine imports, Seth already showed a similar chart. Those are decreasing, but overall Brazil is replacing that. And so we're seeing our market share in the United States from an export standpoint in decline right now. And to a great extent, it's because of Brazil replacing the production we're doing in the United States. So we're seeking more domestic demand sources and developing new demand sources. That previous chart was for corn. Same thing for soybeans. Renewable diesel, this graphic shows our growth in crush capacity going forward. As we work with these industries who are building crush capacity, investors want to see that pay out this year. I think we'll see crush demand exceed what USDA is currently projecting. It's how that balances out and decrease in exports to China that'll be the price key. So summarizing real quick, U.S. agriculture shouldn't count on Chinese demand as it did in the past. Long term, I think India is the next China, so to speak, as far as opportunity. That's going to take time to develop. Focus on developing other markets, especially domestic demand, such as renewable diesel and sustainable aviation fuel. So that's about as quick as I can comment. My mother was not able to get me to talk that short a time, so.
Thank you.
Thank you.
Please join us here. All right, and I'm sure you got lots of questions, so you can start entering those on Slido at any time because we'll do a lot of rapid questions when we get all our panelists up here on stage. Next up is Krista Swanson, who's the new lead economist for the National Corn Growers Association. That's where she's analyzing industry markets and policy initiatives to really provide strategic economic direction to the industry. Before joining NCGA, Krista was a research analyst at the University of Illinois studying farm economics. You probably saw some of her stuff on FarmDoc. She holds an MS in agricultural economics from the University of Illinois. She also farms with her husband and family, a big crop, as well as a crop of 4 kids on the farm. Welcome, Krista.
Good afternoon. It's great to be here with you all today. And like Arlan, I'm going to try to power through 10 minutes the best as possible. I was also given the gift of gab, so I'm going to do my best here. So in this part of the nation, we're in a really exciting season. Harvest season is upon us. And, you know, I think all of us are anxious to see where yields end up this year. I know Seth talked about where those current projections are at, but given the year we've had, you know, there's a lot of variability in those yields. But not only is this harvest season, but it's also another season, and I'm not just talking about the official start to autumn a few days ago, but also what I call input buying season. You know, farmers right now are not only harvesting their crop for this year, but also making some of those decisions and already laying out money and making some of those input purchases for the 2024 crop year. And so for that reason, I wanted to start with a look at cost of production. And so on this chart here, or on this slide here, I'm showing cost of production per acre. This is average cost of production, looking ahead, but also going back to 2021. And I want to start first with looking at that change in cost of production per acre from 2021 to 2022. So across the board, for all crops, we saw a pretty large increase in cost of production at the farm level from 21 to 22. And as we've heard from some of our, from Nutrien, an input supplier earlier, you know, some of that was driven by larger fertilizer costs and chemical costs and fuel costs. and also increasing interest rates were some of those big drivers, again, across all crops. Of course, corn being a crop with greater fertility needs than some of the other crops is a crop that was impacted more substantially than some of the others by that. And then we look at the change from 22 to 23, and we see that on average, there wasn't a whole lot of change in these average costs of production. And again, this is sort of true across all the crops, including some of the others, rice, peanuts, sorghum, oats, and barley that I'm not showing here, but we also have those costs of production forecasts for. And so one thing I want to point out, especially again talking about corn here, even though on average the cost of production doesn't look like it changed much from 22 to 23, an individual farmer likely saw very big swings in their cost of production from those 2 years, depending on when they bought their fertilizer. So again, as was alluded to earlier, there was great big changes in fertilizer prices in this input buying season that extends from late summer, early fall of one year, all the way through late spring and early summer of the next year. And in that 21 to 22 buying period and the 22 to 23 buying period, fertilizer changed a lot. And that's an important point as we move to the next slide where we talk about margins in just a minute. But first, looking ahead to the 2024 forecasts, all the crops are currently forecast to see a small decline in cost of production. But a couple notes I want to make on that are that right now in the last month or two, we've seen fuel prices start to inch upwards. We've seen anhydrous ammonia in particular among the fertilizers start to increase back upward. And we've also seen the latest outlook from the Federal Reserve in terms of where interest rates are going to be at, where they're expecting interest rates to be at over the next year or so. And so as I look ahead, as these forecasts get updated and we have more real values and that becomes more known, I wonder if maybe that cost of production won't even decrease as much as it looks right now. Again, a lot left to be seen, but that's something that I'm keeping a close eye on as we look ahead. And so even though right now we do have this lower per acre cost of production, oh shoot, I went the wrong way. We've also seen this decline in prices. And unfortunately for the farmer, the decline in prices has been at a faster pace than that softening in the cost of production. And so when we look at that on a per unit basis, the unit price there for these commodities shown in black and the cost of production per unit shown in red here, we see that all of these crops are facing for 2024 what is either break even or below break even cost per or margins, excuse me. And so that's something that's really a challenge for farmers to navigate through in this environment. And I think it also underscores the importance of, right now we're approaching the expiration of some parts of the current farm bill, and certainly our legislators are working at writing a new farm bill. And this really shows the importance to our farmers of a farm safety net that is a strong farm safety net. And also, the current farm safety net is multifaceted in that we have the commodity programs and the crop insurance programs. And I don't have time today to talk through this whole slide, but I just wanted to show an example here of what 2023 is setting up to be a year where crop insurance is going to be a very important part of that farm safety net for our corn farmers. We've had two things happening this year. We had our projected price set back in February of $5.91. And that December corn contract, as we here in another week enter the setting of the fall price period, are trading currently around in the 470s. And so we've seen this big price decline in a year where we've also had some major weather challenges in terms of drought. And certainly there's going to be some farmers that have some substantial yield losses because of that. So we have this, two pieces contributing. And I also want to point out that because we had a high cost of production, the current cost per acre for 2023 is projected at $888 an acre. Even farmers buying that highest level of revenue guarantee coverage are just looking at covering their costs with this program. And so it's, again, an important part of the farm safety net. I also want to contrast that with there's a lot of unknowns about 2024, but the way that 2024 could be setting up to be If we stay at these current price levels as we move into 2024, and when that crop insurance price is set for next year in February, we could see much lower revenue guarantees, which means that, crop insurance isn't going to have, it would take greater losses to trigger a payment in that regard. But alternatively, 2024, one component of the 2018 Farm Bill was the introduction of the effective reference price that is part of those commodity title farm programs. And 2024 is setting up to be a year potentially where that is valuable to some of our corn producers. And so I just wanted to point that out, the importance of this multifaceted farm safety net. And then another thing that's been highlighted by a couple of the speakers that we've already had today is that the message of United States agriculture over time being able to produce more with less. And over time, we've consistently shown that we can use fewer resources and increase production. And certainly corn and land use is an example of that. As we look back over the past quite a few decades, going all the way back to the 1930s, the yellow shaded area here is planted acres. And today we are planting fewer acres than the 1930s at the beginning of this chart, and yet production in that black line is like 6 times larger than where we were in the 1930s. And we continue to have those yield increases that drive that increased production. And I think that really drives home the point. Arlan mentioned this and some others, that there's potential, we can be using more of our corn and other grains for biofuels if we have the policy that supports that. And so that's where I plan to wrap up today, and I'm looking forward to being part of the panel and taking your questions.
Thank you. All right, now we're going to invite Roland Fumasi up to the stage. He's the Executive Vice President and North American Regional Head for RaboResearch Food and Agribusiness. I've had the pleasure of working with him in California, and he has had the pleasure of now moving to the St. Louis area since that time and experiencing what water looks like on a regular basis. He is responsible for managing a team of highly respected analysts who each specialize in a specific sector with food and agriculture. Previously, Roland served as a senior RaboResearch analyst covering the North American fruit, vegetable, and tree nut industries. He has a background in agribusiness research with international market development and finance experience in the agricultural industry. Roland completed his Ph.D. in agricultural economics at Texas A&M University. Prior to that, he was an active researcher at the California Institute for the study of specialty crops at California Poly State University, San Luis Obispo, and he received his BS and MS at Cal Poly. Welcome, Roland Fumasi.
All right. Sarah, thank you for the warm introduction. So I'm going to get this joke out of the way right up front, because when I go to my next slide, you're all going to be thinking it. So I'm hoping to just kind of diffuse it now so that you're actually listening to what I say. The old saying that, it's a fact that economists have forecasted 9 of the last 5 recessions. Right? True. Now I'm going to go to my next slide and actually forecast a recession. Right? So my role here really today, what I was asked to really focus on first here, it'll be twofold, is the macroeconomic environment and ultimately what we think this means for interest rates, right? So that'll be the first half, and then I'll talk a bit about the sort of overall financial health, the kinds of things that I'm telling the risk side of our institution. So let's talk a bit about the macro environment. This that you see here is actually based on the Rabobank house estimates. Not every analyst on the team or economist on the team agrees with all of this, but this is our house view right now. We are still expecting that the U.S. will fall into a mild recession in the fourth quarter of this year, okay? Which will continue through Q1 and then we'll start to see a bit of a rebound again. You can see that we're also estimating, as you would expect in a recessionary type environment, that unemployment does start to rise. Okay, that's the dark blue line that you see there. I would tell you that every month that goes by and every new sort of data and information point that we get our hands on, I would say that we're getting closer and closer to saying, we're being too pessimistic on the U.S. economy. The data just seem to continue to sort of stack up against this. So what does that mean? Maybe it means an actual soft landing for the Fed, right? Meaning we won't go into any kind of recession. Or maybe it just means that, yes, we do have this light recession, but maybe it gets pushed out a quarter, right? That's definitely a possibility. And again, every month it seems like it's stacking up sort of against us because the economy continues to be so robust in the U.S., right? Now, this may look scary. You see those two big orange bars coming down for this recession that I'm talking about, or this drop in GDP. Keep in mind, those two bars are like 0.4, 0.5% drop in GDP. So super soft, super light. To put it in comparison, go back to 2008, 2009. We had a quarter back in 2008 where our GDP dropped over 7%. Right? When we shut down the economy essentially for the initial COVID lockdowns, we lost 30%. Right? So again, not trying to scare anybody about recession here, very, very light recessionary expectation. And because of that, we do expect unemployment to rise. Now, what I've shown you here in the light blue line for our inflation estimates, I've actually shown you headline inflation here because, frankly, it's a little more fun to look at. It's super volatile, right? You can see it peak out over there at 8-9% just since the beginning of last year, and our expectations is that it will continue to slide. Now, keep in mind, the Federal Reserve they don't even look at CPI, much less headline inflation. They look at the PCE, and they look now at what everybody's sort of terming super core inflation, right? So personal consumption expenditure, PCE, and then what they do is they strip out not only volatile food and volatile energy prices, they actually strip out housing inflation as well. So that's the Powell Supercore is sort of the name that everybody's referring to it as. That's what they're looking at. Now, while headline inflation is the volatile one, maybe it's a little more interesting to look at, I will tell you that Supercore that the Fed has been looking at has, for the last 2.5 years, been bouncing between 4 and 5% annualized inflation rate. Okay? The problem with that is that's twice too high from what the Fed wants, right? They want to bring that down close to that 2% annualized rate. Now, here's the other interesting thing about that supercore. As you might imagine, it's more heavily weighted toward services. And services are the cost of services is heavily weighted toward wages, right? Now, in the agriculture community, think about that. Think about the Federal Reserve is really watching this index and waiting for wage inflation to significantly slow down, right? Now, most of us in this room would probably all day long, if we could say in the ag industry that our annual wage growth and wage costs was only 2%, for example, which is kind of what the Fed's looking for, we'd probably take that all day long in this industry. So from that perspective, it feels like the Fed's sort of chasing a unicorn a little bit, but we think it's possible. And that's why we think in order for the Fed to really get inflation, this core inflation under control, we're gonna need to see some type of slowdown in the US economy. Right? I don't know how it really brings down that core inflation without us seeing some kind of slowdown like this. By the way, the Fed's outlook on the economy is more optimistic than ours. Go back 60, 90 days. The Fed back then was expecting that they were going to cut rates 4 times next year. But because the inflationary numbers have been so strong in the U.S., now they're expecting they're only going to cut rates twice next year by 25 basis points each. All right? So again, as the data keeps coming out, the economy is so robust that the Fed has a pretty optimistic view on the U.S. economy. So that's sort of their scenario relative to ours. Now, what does all that mean in terms of rates? I've got the 10-year here. I've got a 3-month rate in the 3-month rates in the dark blue to give you sort of a short-term and a long-term view. The take-home message here is that in either of those scenarios, either the Fed's more optimistic economic scenario or our slightly more pessimistic scenario, rates are going to come down fairly slowly, short-term rates. The Fed is going to be very conservative on what it does. You'll see here, again, this is based on our economic projections. You see the 10-year coming down pretty fast, right? And that's due to this economic weakness that we are forecasting. Money tends to flow toward the safe haven of U.S. bonds. It drives the yield down. But you see the short-run rates at the top there. Notice the inversion of the yield curve that you hear about all the time. The short-term rates are expected to come down very gently. Right? So maybe a couple of rate cuts by the Fed next year. Probably the earliest those start is probably second quarter, maybe more middle of the year, beginning of second half. Then likely they're going to come in and cut their short-term rates maybe 4 or 5 times the following year, 2025. And then in 2026, if all goes well and there's no major surprises in the global economy, they'll come in and cut a few more times. Now keep in mind, of all those cuts I just laid in there, the expectation would be that by the end of 2026, the Fed funds rate is still around 2.5% to 3%. Keep that in mind. And that's that range that the Fed wants to keep the Fed funds rate, right? These days of 0 to 50 basis points, it was nice if you're borrowing money, but that's not typical, okay? So that sort of lays out for you the expectation of where we see rates going, which impacts all of us, obviously. Okay. One more slide is all I've got here. So I was asked to sort of go, hey, what do you think kind of about the overall ag economy? Well, the tricky thing about the ag economy is that sometimes you've got industries that are doing well, you've got some other industries in ag that aren't doing so well, so the average looks like, oh, it's okay, kind of boring, kind of solid. And I'm going to try to peel back the onion a little bit. What I decided to use as my one visual was this, though. This is a simulation of annual net cash income and ending cash balance. So a reflection of the balance sheet, if you will, in the dark blue line, ending cash balance. And it's one of we call a representative farm. Okay? So to give you a little bit of detail on this farm, which is pretty cash intensive on the expense side. This particular farm, the assumptions we made is that it's an Illinois farm. It's a 50-50 corn soybean rotation, 2,500 acres. They lease about 1,750 of those acres. They own outright, no debt, only 100 acres. And then the remaining 500-600 acres are financed. The other assumption in this farm that puts it under a little more cash pressure is that we assume that 100% of the equipment is leased, okay, on this particular farm. Now, what's the magnitude that you see on that y-axis here isn't necessarily the most critical part. That's not why I put it up. What I wanted to demonstrate, and this is what I'm telling the risk side of the bank, is this particular story, and that is, yes, you've heard some of the previous speakers talk about the pressure now on margins that we're already starting to see and we think we'll continue to see, but because we've had such tremendous years and those balance sheets are so strong, we're going to be okay, right? You can see this particular farm giving back some cash in the orange line over a few-year period, but you see that dark blue ending cash balance stays nice and strong because we've had a couple of tremendous years. So this is a corn and soybean example. The other reason I liked this was that I can sort of fit one or two other industries into this sort of similar pattern. When I think about the dairy industry, right? Again, it's not going to match perfectly, but the dairy industry came off of, in the first half of 2022, really building balance sheets. Great, record first half of last year. Then things started to slide, and now, frankly, 2023 has been really, really rough on dairy producers, right? They've been giving back some of that cash, but they're starting from a very, very strong cash position, strong balance sheets. So I'll give you one last example that sort of doesn't necessarily fit into this, and that would be, this was alluded to earlier by one of our speakers, the beef cattle segment, right? In the beef cattle segment, they've really come into their profitability, strong profitability stride sort of in 2023, right? And we expect that cattle supplies are going to continue to tighten. That's going to get worse before it gets better. And prices will continue to be really strong as we roll forward. One last piece of this. I will tell you that most of this reduction, this sort of give back of cash here, is primarily due to compressed corn margins. Right? We think soybean margins are going to hold up and be a little more stable. Right? We just saw some examples, reasons why from the previous speakers. And then when you see that annual net cash income start to rise again in those out years, it's because we do see, again, there's some cyclicality, we do see those corn margins start to kind of expand out there again. So this is a longer term sort of view, sort of story. But again, my main takeaway here is that yes, things aren't as great as they were. They're not going to be as great as they were the last couple of years, but we're really starting off from nice, strong financial positions. And that's what I've got for you.
Well, thank you, Roland, and thanks to all of our panelists for great opening presentations. I can see some questions are coming in right now, so I'll have a chance to look at those, but I'm going to kick off with the first question. And everybody can jump in on this however you'd like. Seth, I'll let you start. In terms of what Roland just said, that there's still, everybody's going to be all right. But there's also going to be folks who are saying, okay, well, where's the next big revenue opportunity and how soon is it coming? Is it carbon? Is it, sustainable aviation fuel? So I'm just wondering, in your crystal balls, from all of you here up on stage, what are the next possibilities for new revenue opportunities for our farmers in the audience?
Oh, okay, you want me to go first?
Yes.
Okay. I think that as far as new revenue streams go, I would at least say the department, USDA's role here is to facilitate the markets for as many income streams for producers as we can. And I think you see, to me, some of the development of things like our commodity smart, our climate smart commodities program is in order to try and to put a framework around this to facilitate farmers' ability to sell those services or sell those environmental benefits. So I do think that there's an opportunity there. I do think it takes USDA, and USDA is trying to dig into this a little bit to try and facilitate it. I think you and I talked about, when we exchange number 2 yellow corn, I know what I'm selling you, and you know what you're getting without ever seeing it. So when our colleague from EPA talked about MMRV, and our friend from Cargill talked about MMRV, measuring, monitoring, recording, and verification. Can we reduce the transactional costs so that agriculture can participate in this market? And then I think you'll see those revenue streams come on. So I think that that is certainly an opportunity for revenue streams. It's just going to take some market development, which is what a USDA is trying to do.
Get the measurement right first. Arlan, anyone else want to jump in?
New revenue opportunities, I'd say really push the biofuel opportunities, obviously. I think particularly if we can find a way to get the subsidies to support ethanol as a feedstock for sustainable aviation fuel, that would be a big deal. Although that kind of goes against the soybean industry's wishes because they want to be a primary feedstock there. But together, anything we can do to support the biofuels going forward, I think that's huge, as well as those checkoff dollars have been a huge part in our industries finding new uses for our crops, and I'd continue to support that.
Yeah, I'll echo what Arlan said in terms of the modeling used to set those, some of the incentives for that were included in the Inflation Reduction Act and supporting our biofuels as a user in sustainable aviation fuel. Our market development action team recently had a study done, and as we look over the next 5 years of potential for sustainable aviation fuel, the trend yield growth that we can expect from corn alone could fill that demand for sustainable aviation fuel over the next 5 years, but we have to have the modeling that allows for that to happen. And I'd also add on the corn side, like another thing, we've been really focused with the growing competition from Brazil. We've been very focused on, that corn export number. But I think it's also important that we think about, corn exports are not only in the form of corn as the grain, but also the opportunities that exist for expanding exports of value-added products like ethanol and, our meat products. And so that's going to be really important for our industry too.
So you're good. All right, questions are coming in on India and what the potential is there. Obviously, the population in India is incredible, but we also have a lot of trade restrictions in terms of what they're doing there. So question asked for both for Seth and Arlan to comment on, what do you see as a potential there? And also, I think it's necessary to talk about the challenges, especially politically, as they look to protect their own production. What do you see going forward for India's market potential for the U.S.?
Go ahead first.
I guess I'll keep mine pretty simple, and I'll just say, look, I understand India's got the world's largest population, domestic food security is an issue, but I do think you have to take careful consideration about how you approach your domestic production and trade policies, not to transmit your volatility or your problems into the rest of the world. So I think I'd keep it maybe simple like that, and I'll let Arlan talk about the demand potential side.
Yeah, and as we look at soy meal, obviously we think of livestock production, meat production, so that's going to be a slower development in India for cultural reasons there, as well as other things. But with time, I believe will come. I think Africa is a wide open market. The soybean industry is pursuing some opportunities there to develop those markets. I think obviously there is a lot more instability in the governments in many countries in Africa right now, which creates some challenges. But from a standpoint of development of market potential, I think there's a tremendous potential there.
And just while we're on India, one other question came in about what's the potential for changing their import restrictions on dairy? I don't see
I'm not super optimistic. I wouldn't be super optimistic about that. I'll leave it at that. One comment on some of the demographics, India, China, some of those changes. I think that's critical, and I'm glad Arlan nailed that today. I think the other thing that we always like to keep our eye on is what does per capita income growth look like? When you think about the kinds of things that we're good at here, right? We're good at feeding livestock. We're good at producing very, very high quality foodstuffs. And of course, as incomes rise in some of these other countries, sometimes you even have sort of an offset. You may have a population shift but sometimes that can be offset in a positive direction with continued income growth, where you have greater demand for things like animal protein as those incomes go up. So just another piece of that puzzle.
Krista, you talked about some aspects of the Farm Bill, which we hope will get started yet this fall. But you mentioned crop insurance. As you look at NCGA's top 1, 2, maybe 3 priorities, what are those, and what do you see as the threats to those?
Yeah, so I mean, certainly our members have said loud and clear that crop insurance is their #1 priority. I already talked about that a little bit, but maintaining a strong and actuarially sound crop insurance program is really important to our organization. Also, looking at those Title I programs, maintaining that effective reference price mechanism, which, like I mentioned, we might be coming up on a year where that does come into play and could be important in terms of the Title I programs. And there's we have some other proposals for how to improve those. And then, of course, strengthening the market development program and the MAP and FMD, the two programs for foreign development. And we're thankful for CCC, or Secretary Vilsack, recently announcing to use CCC funds to support those programs, but we also want to see those continue to be included in the Farm Bill and the baseline for the Farm Bill, just thinking about the future going forward. I will also note that our delegates this summer also approved a new policy to support a base acre increase. So those are kind of related to the Farm Bill and conservation programs as well. So,
thanks. Roland, you talked about how things aren't going to be quite as good as they have maybe in the last couple of years, but still fairly, good environment. How do you think, for the agribusiness leaders in the audience who are, they want to sell iron, they want to sell more inputs, are growers going to be a little bit more conservative during this environment that you've detailed, or are they going to be, still going great guns on input purchases? How do you see that kind of playing out as we go into 2024?
Yeah, no, absolutely. So the big metric we look at is kind of that we call it share of wallet, right? So I'll give you an example of what I mean. As fertilizer costs have come down significantly, right? That starts to leave a little more room in that wallet for the farmer to be willing to go ahead and spend on something else, for example. Granted, and somebody touched on this earlier, there is risk to the nitrogen complex more than anything else in fertilizer, we think, because of its tie to natural gas. We're going into the winter season in the Northern Hemisphere. We know Europe has sort of fixed sort of that big panic that they had a year ago in a lot of ways. But again, you can get an extra cold winter, and all of a sudden you can see natural gas come up and start to put upward pressure on the nitrogen complex. So yeah, that was a little off topic there. But so, and as fertilizer costs have come down generally, right, that's made a little more room. For example, seed costs have gone the other way. They've actually come up. So I think we're in a situation where producers are going to continue to they tend to try to want to maximize yields. Now, we can argue that that's really the right metric that producers should be looking at, right? Should always be looking at net income. But that's a long way of saying, yeah, I think they're going to continue to be willing to go ahead and try to drive those yields, which are so important on farm, and spend the money it takes to get there.
Speaking of purchases, one of our questioners wants to know about what's the outlook for farmland values. And I have to say that as much as you think about higher interest rates and the volatility, and then you hear somebody just spent $30,000 an acre on buying some farmland in Missouri, I'm like, maybe Illinois, I've heard that, but so there still does not seem to be a shortage of interest in farmland. Which way is it going to go going into 2024?
I can start if you want.
Sure.
Look, I think, and we've got a fairly robust model on farmland values that we use. We're sort of at that period, and we're at that point now coming off these two really good years and things softening up a little bit, well, we're likely to see a much more conservative change in average cropland values. Right? That tends to be what we estimate. There's always going to be pockets. There's always going to be buyers that are willing on the positive and the negative side. Right? You look at some pockets out in California that just don't have robust access to any surface water out there. Some of those land values struggle. Right? You hear some of these $30,000 an acre sales. Again, there's these pockets, but average cropland values in the U.S., and if you look at the historical numbers, this will play out. We've had 3 tremendous years of growth in ag land values. It looks like now we're probably at a time where the next few years going to be a little flatter, right? Maybe we even give a little back in average land values, but that's low single digits, if anything, right? And then you go out a few more years, and then you probably see that next sort of stair step up. That's what ag land values look like historically. Sideways a little bit, up. Sideways, take a little break, up. Producers look at these as generational assets, right? You go, how does a capitalization rate make sense growing row crops on $30,000, ag land? Maybe it doesn't. But when I've got my other 12,000 acres at a basis of $2,500 an acre, blend all that together, I've been out after that piece of ground for the last 30 years, and they're finally willing to sell it to me, and I'm thinking generationally, okay, I'm going to step in and make the purchase.
Don't forget the 11th commandment in agriculture, whether it's right or wrong. Never fail to buy that quarter section of ground that became available between you and your neighbor if he wants it.
That's a good saying.
No matter what the price.
So we haven't really talked about the swine herd. You mentioned a little bit about the demand and what's happening in China. Thoughts on future of the U.S. swine herd for our pork producers that are in the audience?
I won't talk. Hogs and Pigs is Thursday, and I'm signing, so I'm not going to make a guess a few days before I could be wrong. But certainly, I think the person describes it as some potential tightening. We'll see. Thursday, we'll see. We've been seeing an increase in sow liquidation, sow breeding slaughter. Not to the extent that we saw in the cattle herd, but certainly the hogs have been seeing those tighter margins. That's been resulting in that. So that would suggest that we're pulling numbers down. Then it comes down to litter size as far as what our available hogs will be. We've had some trouble with disease in the hog herd that have affected surviving litter size here over the last couple of years. Hopefully we're getting past some of that. Was the last readout on pigs per litter sustainable, a fluke? I think we have to go through another winter to really get a feel for that, yeah. Sorry. Yeah.
No, it's great to ask each other questions as well. So one of the other things that has come up as a question is, what surprised you as an ag economist? Now, it was directed at Roland, but I think it'd be interesting to hear from all of you in the last year. What's been a surprise? So Roland, I'll throw that at you first.
Yeah, I guess looking back now, it doesn't feel like such a surprise when you look at all the spending patterns of the younger generation, right? When you think about the younger generation, the newer generations, I should say, yeah, maybe they create sometimes some challenges, some of the changes they want the food and ag system to make, but they're foodies. And this has surprised me. I've really had to work through this in my mind. You've got folks, maybe they're not that interested in owning a house. Maybe they're not even that interested in owning a car. But they like to consume good, high quality, relatively expensive food. So that's been a refreshing thing to recognize.
Okay, Krista?
Yeah, I would say like one thing that I've been thinking about a lot, or we've seen South American production growing rapidly in terms of corn and soybeans and becoming more of a competitor in the world market. And at the same time, I don't even know how many times today the word sustainable has been used, and that's been a huge thing, certainly in United States agriculture, and the push to become more sustainable. But then I think there's a little bit of a disconnect when we look at China as being a big part of our export market, and then we've lost some of that market share to South America, as they've been, especially this year with the strong dollar values, a lower cost producer for China to buy from. And then I think about China. Do the buyers in China? Is sustainably raised crops important to them? And so I feel like we need, so I don't know if this is surprising or if I'm answering this right, but I feel like that, there's some disconnect in that, and how do we create value in the marketplace for the farmers of the United States that are making these strides to be more sustainable, and as has been alluded to a lot of times today, that incentive that is needed, so that way we can sort of balance out some of these shifting trade flows that are happening.
I think one of the big surprises to me is how little attention is being paid right now to the impact of the national debt on our ag economy and going forward. When you look at, 14, 15 months ago, our interest on our national debt was like 350 billion. Now it's approaching 700 billion. If you look at the CBO and the Office of Management, OBM, Office of Management Budget, OMB, projections for 4 years from today, they're projecting it to be closer to 900 billion to $1 trillion per year for interest payments. USDebtClock.org says if we continue on the same path we're on, it'll be $1.7 trillion per year. We've already saw what happened on the day that Fitch downgraded our U.S. credit rating from a AAA to a AA+. We saw a big sell-off in the grain and oilseed markets. In fact, all of the commodity markets virtually, as well as the stock market, on a day when we had bullish news in the grain markets. That's the impact it can have, and it has. We saw interest rates go up, treasury yields go up with the downgrade. And that's going to become a bigger and bigger issue. I anticipate it'll probably come to a head right after the 24 elections, because the last debt ceiling agreement only goes till January 1 of 2025, so I anticipate it'll be dealt with between elections and January 1 in some way. But it's blowing up our national budget right now. Neither party in Congress has really shown the ability to do much about it, but it is increasing your interest costs. If you look at 10-year Treasury yields and how they're trending higher regardless of what the Fed is doing, it is having an impact on the farm. That increases the cost of storing grain on the farm, ultimately leads to higher food inflation as well. So I think that's one of the stories that I'm surprised has not received much attention yet. But I do believe it will receive a lot more attention over the next 12 to 14 months.
Anything still surprise you?
Well, yeah, I'm going to interpret the question to be, what have I been wrong about over the last 12 months? So I'm going to pick one of those things. So I guess that I would just say, and I think I talked to you about this before, which is I think a surprising amount of flexibility producers showed between NASA's planting intentions report and what they actually planted as well, too. NASA's always pretty close when it comes to principal crop area totals, but we saw a lot of shifting there, and so that shows some flexibility in producers between that observation of kind of the first bit of a negotiation and where they actually ended up. So I think that was an interesting surprise this year. Maybe not surprise, but an interesting development.
All right. Well, I hate to say we've run out of time. This has been an excellent discussion. Seth, Arlan, Krista, Roland, thank you so much for all your contributions. Let's show them our appreciation.